This past year, members of the Congress have beaten yet again the S&P 500. For example, Nancy Pelosi's portfolio is up 25% in the past year, while the S&P up 15%. If we go to her holdings, a stock Nancy has been buying this year is Google, which is up 65% in the past year and now has a market cap of $3.8 trillion, which is what it would cost you to buy all the shares in the market, and makes it the fourth largest company in the world. They are trading at a forward P of 29, although we'll talk later about the valuation with a discounted cash flow model. Google has seen amazing revenue growth in the past decade, growing from $74 billion to $385. And analysts are expecting this revenue growth to continue, as they have Google making $722 billion in revenue in 2030. Therefore, a compounded annual growth rate of 12%. Their profit has also seen insane growth, as net income has grown from $16 billion to $124 currently. One downside of Google's financials is that free cash flow is significantly lower, only at $73 billion. However, the reason for this is that capital expenditures have increased as they are investing a lot of money in AI. They also have fantastic margins, as gross margin is around 60%, profit margin 32%, and free cash flow margin 19%. This is why analysts are also expecting tons of profit growth, as you have Google making $10.90 per share this year and growing to $20.35 per share in 2030, so basically a double. And if we look at the last earnings report, subscriptions, platforms, and devices grew 20% year over year. YouTube ads grew 15%, and Google search grew 15% as well. So I think it's clear that Google is not going to get hurt from AI, which was the fear and what made the stock price fall to $88 per share. And Google also has an exceptional balance sheet, as they have $98 billion in cash and $44 billion in debt. With this extra cash, they've decided to pay a small dividend, which currently has a yield of 0.27%, meaning you get 84 cents per share annually, and they've also decided to buy back shares. I am actually against these two decisions because I would prefer if Google used that cash to reinvest in the business, as I believe they still have a lot of growth. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $169 per share, middle $263, and high $394. And because the stock is currently trading at $315, this means that if my low assumptions occur, you would get a negative 0.4% annual return on your money, middle positive 7%, and high positive 14%. Now, as far as my assumptions, I assume Google grows revenue between 7 and 13%. They average a profit margin and free cash flow margin between 22 and 32%, and I assign the PM price to free cash flow at the end of the 7 years of 22, 24, and 26. And in conclusion, while I believe Google is a fantastic company, I believe the recent run-up has made the valuation a bit expensive, and there are better opportunities in the market. Remember that the issue with members of the Congress is that we don't know exactly when they buy or sell stocks, because under the Stock Act, they only have to disclose the trade within 45 days after it happens. That delay, combined with disclosure only in broad value ranges, makes it very hard to copy their trades. Another stock bought by members of the Congress is Netflix, which is down almost 30% in the past 6 months, mainly because of the concerns around the Warner Bros. Acquisition. Netflix is the #1 streaming platform in terms of subscribers, and if they acquire Warner, they would also have HBO, which is currently the 4th, along with all the brands they own. Again, this will happen only if the deal goes through. Netflix will be paying $27.75 per share of WBD, with the total value being $82.7 billion. Now, they are paying 25 times EBITDA for WBD, which in my opinion is quite expensive. But despite this possible acquisition, we have to analyze Netflix on its own. And Netflix growth has been amazing. Revenue from $6 billion to $43 billion in the past decade, and net income from $100 million to $10 billion. Amazing margins, as gross margin is 48%, profit margin at 24%, and free cash flow margin at 20%. Analysts are expecting tons of growth as well, as revenue is expected to reach $75 billion by 2030, and profit is expected to almost triple and reached $6.60 per share. The issue I have with Netflix is the valuation. As you can see, the intrinsic value according to my low assumptions is $44 per share, middle $65 and high $99. And because the stock is currently trading around $91 or $92 per share, this means that if my low assumptions occur, you would get a negative 2% annual return on your money, middle positive 4.2%, and high 11.3%. I think I made reasonable assumptions, but if you want to make your own, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And in conclusion, Netflix, even if the deal goes through, I believe is overvalued despite the recent sell-off. And the last stock is Broadcom, ticker symbol AVGO, which is Nancy Pelosi's third biggest position and accounts for 15% of its portfolio. Analysts have them ranked as a strong buy with 22% upside. It's a very large company with 1.3 trillion market cap that has done exceptional in the past 5 years with returns of over 700%. Broadcom is in the semiconductor industry, which has been a very hot sector this year. We can see this in the numbers as revenue has almost doubled in the past 2 years and it is currently at $63 billion. And net income this year alone has quadrupled from $5 billion to $23 billion. AVGO's margins are amazing as well, with gross margin at 77%, profit margin at 36%, and free cash flow margin at 42%. With this company and the semiconductor companies in general, we need to ask ourselves the question if this amount of growth is going to continue or it's been a hot couple of years. Is it sustainable? Analysts seem to think so because revenue is expected to grow at double-digit percentages in the next 5 years and reach $231 billion, and EPS is expected to double and reach $23.73 per share. Now, there has been a recent sell-off. As you can see, the stock is down 11% in the past month. In my opinion, this is because the valuation is a bit stretched. They are trading at a P of 77 and price to free cash flow of 60, which could be justified if the insane growth continues. But is this probable? In the discounted cash flow, as you can see, the stock is currently trading at $344 per share, and I have intrinsic value between 124 and 321. Keep in mind that on my high assumptions, I have the company growing revenue 20% for the next 7 years, averaging margins of 45%, which they are not even doing at the moment, and I assigned a premium over the market average of 15 of 24 PE. In my opinion, the stock is just very expensive at the moment, and if you are a value investor, you know that picking the right stocks isn't just about the story, it's about mixing it with the numbers, and that's exactly where StockAnalysis.com comes in. This site lets you go deep, track up to 10 years of historical financial performance, see revenue, profit, margin, dividends, everything. If you want a discount code, you have mine in the description. They also have a free newsletter that highlights important market moves and stock fundamentals, perfect if you want to stay informed without spending hours digging through data. I hope you found this video valuable. Let me know what you think about these stocks in the comments, and I'll see you in the next one.